Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending September 11th, 2020. I'm Preston Brenton. Thanks for tuning in. As a reminder, everybody don't be a rat brain trader. We want to be the red striped zebra, which means we stand out from the herd. This week's theme is ready to pop. Now, are the markets ready to go down further, or are we going to start to consolidate, or is this just a big buying opportunity? We're going to talk about that in just 1 minute. Before I do that, though, let's just kind of take a look at where the markets are shaping up for this past week, not only here in the U.S. but globally as well. So let's look at the markets right here. You can see in the upper left-hand corner, Dow, S&P, Nasdaq, and Russell all had a red week for the week. The Nasdaq, as you can see, was down 4.06%. And then the S&P was down 251 and Russell down 248. Okay, and you can see with these markets here, year to date, the only thing in the green right now in the U.S. markets is the S&P and Nasdaq. And if you look over to the right, you can see the trailing 12-month PE ratio is a whopping 36.58 for the S&P. The forward PE ratio is 25.57. More on that in a minute, but it's lower by 30.09%, the forward guidance for the 12-month PE ratio. The dividend yield is sitting at 1.79 and the 10-year treasury is at about 67 basis points roughly. And the spread between the dividend yield and the S&P and the 10-year treasury is about 1.12%. So money still wants to flow into the equity market. You can see the current VIX closed this week at 26.87. Last week it was at 30.75. So the VIX actually closed down 12.61% for the week. And notice over on the left-hand side, all the markets were in the red, which is really unusual for the VIX. Just a lot of unusual activity and volatility for this prior week. Now or this past week, and that kind of gives me an idea that this is more of just a profit selling kind of thing as money was shifting from a technology heavy market over to more cyclicals and industrials, right? And even some value stocks. Now you can see the U.S. sector performance for the week. The best was materials. It even finished in the red. It was the best performing sector. It was down only 84 basis points. Last week, it was also the best performing sector, but it managed to scrape by with just a small gain. The worst this week was energy, down a whopping 6.8%. You can see the annual sector performance on the right, technology finishing in the green so far year to date 20.80%, but I think everybody probably fundamentally understands that. But look at energy, almost down 50%, coming in at 47.15%. Now, if we look at the world indexes this past week, you would think you were in another alternate universe because just about every market over in Europe, well, in fact, every market in Europe, every major market from London FTSE to the French CAC 40 to the German DAX, all in the green, and FTSE was up strong. Year to date, they're still all in the red, but I think the DAX is going to be the first index over in Europe to broach into the green year to date. You can see even Japan was up 87 basis points for the week. Year to date, it's down only a little over 1%. China and the Hang Seng, the Asian markets, were in the red this past week. China is the only index in the green, 6.89% year to date. So really, if you look at it, in the green year to date, we have the S&P, Nasdaq, and China, the main index, Shanghai index. That's about it, guys. So the markets are, after this COVID response in March, with this big drop off that we had in the first part of March going through to the lows on March 23rd, markets are really, though, having a very strong recovery. And while it's a bit uneven, primarily focused on tech and those companies that specialize in work from home types of things, I think we're going to see the market start to settle in a little bit more as we go through the end of the year, although there's still some upside left. And then in 2021, I think there's even more left. And let me just talk a little bit about that, and then we'll go take a look at the charts here. So let's look at the weekly sound bites. Again, let's talk about markets for a minute here. As I said, the tech-heavy Nasdaq really had the worst week, and it's in correction territory, down more than 10% from the all-time highs that they made, the Nasdaq, on September 2nd. And energy stocks, just oil futures continue to sink below. It went below $40 a barrel for the first time since July. And as I just mentioned, stocks across Europe continued to recover, mostly in the green. And we did have the ECB this past week come out and announce, they didn't announce additional stimulus, but they're very supportive of the markets, and they'll probably follow in the Fed's footsteps as they typically always do, right? Um, as always, the top 5 stocks in the market and the market cap. If we look at Apple, Amazon, Google, Facebook, Microsoft, these companies, their valuations have climbed over 30 times earnings, all right? And the spread between these 5 company valuations and the remaining companies in the S&P, the valuations of those is wide and getting even wider. In fact, the spread here is as wide as it was in 2018, but the markets, you got to understand, are always self-correcting. And it was this wide in 2018 until we had a major correction that pretty much narrowed that gap a pretty good bit. Okay. So that's something that I believe is just it's just a foregone conclusion that we're going to see that. And speaking of market caps, the S&P, if you compare the S&P valuation to the GDP, not quite what Warren Buffett does, because they talked about that last Sunday, but similar. If you look at it, the GDP of the U.S. Back in 2009, it was approaching overvalued, and we all know the markets, 08 and 09 pretty much came down hard. But the current valuation of the companies, the market cap, I guess, of the U.S. companies in the S&P total about 35 trillion. All right, and if we look at the GDP that came in Q2 of the U.S., it was only 19.4 trillion. Now, granted, that includes March. I mean, it was just really tanking, but it came in at 19.4. So it shows historically, the markets are fairly expensive. We got a forward PE, as I told you guys, of about 25 and a half. Okay. But that is in context with very, very low interest rates. And when you've got low interest rates like that, it has a tendency to jack up the PE ratio. So if you look at the earnings projections for 2021, and if you take, in fact, Barron's this week, and they ask a bunch of analysts, and the average, let's say, comes in around $1.60, 160 for earnings per share. And you take the current PE ratio, assuming interest rates stay where they are, because I suspect they will, that would imply an S&P of around 4,000. Okay. So that's a big move up from here. In fact, most of the analysts next year are pegging the S&P around 3,800, okay, for 2021. Not this year, but for 2021. So we're going to watch this very closely. And I would also agree that I see upside here after we get through with this little profit-taking pullback. Okay, I don't think the markets are going to go down too much lower, but we'll look at the charts and I'll show you. But that's kind of what I'm seeing. Now, if we look at the interest rates and money supply, that's also helping keep interest rates very low. Okay. The 10-year, as I said, finished the week at about 66 basis points, 67 basis points roughly. That's very low. It was down from the prior week. And that gives you a 1.12% spread between the S&P dividend yield and the interest rates. It just channels money into the equity market. It's very simple. Now, if we look at all the global central banks, the balance sheet has grown about 33% on average year over year. If we look at this year compared to last year, and here in the U.S., our balance sheet's grown about 23% year over year. But again, the flow of capital, low interest rates, it's going to continue to nudge investors into the equity markets. And if companies come in and they hit their target earnings per share in aggregate in the S&P of around 160, you're going to see, assuming investors are willing to pay 25 forward PE ratio, which they are right now, then 4,000 is clearly in the cards for the S&P. All right, so it just goes on valuation, and money goes where it's treated best. Okay, so that's something that we're seeing there. And then one final thing, I'm going to bring this back up because I'm sure it's going to surface again and again, is Brexit. Okay, tensions kind of heated up towards the end of this past week as the UK and the European Union, began their new round of talks to kind of flesh out their post-Brexit relationship. And it didn't really help when the UK published a draft law this past week to create an internal market after the December 31 Brexit, right? And some of those elements of that draft law overwrote some of the sections of the agreement that the two sides, the European Union and Brexit or Great Britain, had already established last year. So obviously that pissed off the Europeans, the Union, right? So the UK government conceded, in writing that some of the clauses would breach the international law. And of course, you knew what would happen. That prompted the EU and the European Commission to threaten legal action, and to prepare their member states of the EU for a no Brexit deal. So there's enough risk on the horizon there to keep volatility elevated. And when we went through that March move lower, I told everybody just anticipate vol is going to stay north of 20, probably through the remainder of this year. Anytime vol gets over 50, it stays elevated for 6 to 9 months in normal conditions, right? And we've certainly had 2020 abnormal conditions. So that's kind of what we're seeing here on this. What I'm gonna do is I'm gonna shift you over to the charts here. So I'm going to just move the screen over a little bit and get you on a screen that I want to show you. So let me just do that. And then I'm going to wait for it to paint on the screen. And then as soon as it comes up, I'll kind of just go through some of the charts here. Now, what you're seeing here on this chart is the S&P 500 E-mini futures. Okay. And let's just kind of break this down a little bit and take a close look at it. As you can see, the purple here is volume over price. And you can see I've got a number of spikes in volume over price at key price levels. And that tends to generate key pivot points, key price levels. And then you can see the gap in here like that tends to be where if we fall through a level like right there, there's not a lot of potential buyers at that level there. There's more standing in line to buy right there. And then if we break that level there, we come down like this, and then there's more buyers right here. Okay. So you can see if I were just to extend this line out right in that area there, obviously that's where a lot of buyers and sellers had a big fight. The buyers won and jacked it up, but that was a breakout, right, from prior all-time highs, and now we've given it all back up, and now we're sitting right on the 50 EMA. And now you can see where if I were to extend this line right over, that was a prior resistance point, and we are sitting right on the bottom of where the last big skirmish happened between buyers and sellers. Okay, and I've got on a smaller time frame a potential support point. So let me just blow this up, because this bigger bar right here was generated on a weekly time frame, and that was my resistance point. We came right up and hit it. This was a resistance point right here generated on a daily time frame, and you can see we came right up and just kind of we paused a little bit, and then we came right up and blew right through it. All right, and these lines are drawn on, I'm using the advanced Git version of eSignal, and it is a combination of Gann and Fibonacci, either Fibonacci extensions or Fibonacci retracements. So when it puts these two together, and it takes a kind of like a regression analysis, kind of almost best fit, because it looks at the prior Elliott wave, leg count, wave count, and so forth, and comes up with these numbers. And I find that they're good 65% of the time, a little over 65, 70% of the time. So they're fairly accurate. Now I could draw them on my screen, but it just creates so many lines, it's a little bit confusing. So this just makes it a little bit easier to do. So if we zoom in on this chart here, and let me just get it here, you can see here that little support point on a 4-hour chart is what I generated this past Friday. You can see we're holding the 50 EMA on this. Well, actually, this is an SMA on this chart right here. It's a 50 simple moving average. I've got EMAs on the other, but we're kind of holding both at the same time. Both the SMA and the EMA are very close together. And you can see where we're holding it right here. This is my S1, or the next level of support down here at that fib node, 23.6, 32.52. And if we can hold 3,300 going through next week, that'll give the bulls enough chance to take us back up into this R1 level up here, which is around 34.05, 34.10 area. Okay. And I would actually clear it once we get over 34.50. Then I think we're going to be, running back up to challenge these highs here again. But right now, we're just going to go through some basing pattern. And I don't know just yet if the move is still over, okay, to the to the downside, okay. You can see right here, I've got a pullback point here sitting right around 32.75. And then I got a little bit further one out in time sitting around 3,200, okay. So that's a little bit about what I'm looking at. 3,200 is going to be one of my bigger pullback points in this thing. If we look at Nasdaq, right, because Nasdaq is the one that has kind of started the ball rolling to the downside, you can see we actually closed below the 50 SMA, all right, for the week. And we're sitting at some volume area right here, but we're below the 23.6 fib node. The next big support point is down around 10,300 on the Nasdaq NQ1, the Nasdaq 100 futures. Okay, so we're going to watch this very, very closely and see how this thing kind of plays itself out. Now, if we come back to the E-minis, and let's just put it on the Ichimoku here real quick so that you guys can just get a different recap of it. On the Ichimoku, you can see I had a rising wedge on this. Now, I could have drawn the same pattern on the other chart, but I just drew it here to alleviate a lot of lines on the chart. You can see this rising wedge here, and we broke this line right here. Okay, you can see this upslope and trend line here, and we had a number of touches, so it was valid. We climbed back up, and then we broke right back down again. I've got support showing here around 3,200 on this daily chart, looking at the Ichimoku. Okay, and the red line is almost right on the blue line. Okay, so that would be, the red line is a 9 SMA, and the blue line is a 26 SMA. The 9 SMA in Ichimoku language is a Tenkan-sen, and then the blue line, the 26 SMA, is called the Kaijun-sen. So these lines I watch very closely as well. So we're right on top of each other. If it breaks down, then that just tells me, or would help confirm, that the markets are going to continue to move a little bit lower. Okay. So that's a little bit about what I'm seeing here on the E-minis, right? And let me just shift it back over. And then what I'm going to do is I'm going to move my screen over to another chart here. Let me just get this over here like this so I can move the screen over and get it up for you guys. Let me just switch like this. So bear with me 1 minute as I move my screen over to another screen right over here like this. Now, what I'm going to show you here, if we look at the Russell, okay, and you can see right here, this is where the closing price was for 2019. You can see it's sitting on the 50 EMA. It's almost kind of running flat. This is the 200 EMA. So remember, now we're looking at EMAs versus SMAs, right? And they're almost exactly positioned the same. But we've got a lot of support underneath here. If we move back into the red, that would put us below this blue line here. So if we come down and we look at the Russell, okay, which is small cap basically, you can see here we've broken clearly below the 50 EMA and finding 200 EMA as support here. Should this break down again, it's going to get us ugly for next week, I think. Okay, we get a little bit more downside left in this market. Right. Now, if we come over here and look at volatility, here's the interesting thing. I wanted to show you here. Let's come back up here to the E-minis, and let's go to September the 4th. Okay, I'm going to blow this up, and we'll put it on here like this. And if we look at the candle on September the 4th, it's this candle right here. Okay, and this is, and you can tell from September the 4th, we started at 34.54 and we closed the week at 33.27, right? That's where we closed. So you're looking at about 120 points roughly to the downside. So now let's go to September 4 on the VIX. And let's look at what the VIX does. Okay, so if I come over here and I look at the VIX, and let's go to a daily chart, September the 4 was right here. When we peaked in the VIX, it got all the way up to 38.45. And the VIX came all the way back down and closed near the lows for the day on Friday at roughly around 26.89. Okay, so we've moved down dramatically in the VIX. Okay, it actually closed the week, I think I had said earlier, at 26.87. So you may be thinking, well, the VIX went down for the entire week, and yet the markets went down. That is very unusual. But here was what was even more unusual: as the markets, the U.S. indexes were going up, so was the VIX. Okay, so we had this very unusual correlation going all the way back to about the last week in August when the VIX was going up as the markets were going up. And then when the markets rolled over, the VIX rolled over. Very, very unusual volatility action here. Okay. I think we're going to see some more strange doings with VIX as we go through the end of the year, because here in the US, we got the presidential election. It's going to be a very interesting one. I think volatility is going to remain because I would not count on knowing who won the election the day after election. All right. Um, and once that happens, that's the first week of November, it could run out even further. And I will remind you that when we had the Hanging Chad event with Gore and Bush, and it was the Hanging Chads in Florida, and we had to take it all the way out for, I guess, a couple of weeks to figure out who won the presidential election, the S&P fell a little over 6%, all right, as that turmoil built up. So if that happens this time, expect volatility to go higher, okay? So we've just got some interesting action on the tape here with the VIX, so we have to watch it really carefully to see. If we look at the front month VIX skew, you can see here the VIX is going to expire this week, so it's natural for it to expire right at zero because the VIX and the front month vol futures equal each other on expiry day. So we're going to get that shortly. And then if we look at the back month, which is probably more indicative, you can see here in the back month, we're well into the green. So the term structure is normal. In fact, the term structure has been going down and down and down and down. Okay. So that just tells me that the markets, while historical volatility is very high right now, and historical is the actual movement, the VIX itself is not moving to reflect the actual movement of the price action. Okay, so there's going to be opportunities in the markets for those of you that are option players. For our members, we'll go through this Sunday evening, but you can see just some of the craziness that we got. So we've got a normal term structure in the back month volatility, all right, sitting there right now. That just shows the markets, they're not that fearful. This is just a measured sell-off that I'm looking at right now. And of course, we go over and look at bonds. We look at the bond market. Again, here was the big range right here between these two dashed yellow lines on the chart from 182 to 177. All right, we did extend down to 170, but I think we're going to stay around the mean, which is around 177, give or take 2 or 3 points north or south. So there's some great option strategies to play given that. And we've been like this going all the way back to March. Okay. And the reason why it hasn't moved that much is because of the Feds. The Feds have committed to keeping interest rates low. All right. Even if inflation is starting to come back in, the markets aren't really pricing that in just yet. In fact, we go out over a year, the Fed fund futures is pricing in inflation, or interest rates are going to stay low and inflation is going to stay low. So that's kind of what the markets are saying. Now, that doesn't mean that's what's going to happen, but that's the way the markets are pricing it out right now. Okay. If we come over and look at the 10-year interest rate, it closed down for the week, right? But we're right smack dab in the middle of where we've been. Outside of an excursion here in June, I expect interest rates to stay here. Great trades on TBT, right? If you wanted to put some flies on and put the guts in the middle here, you can play this fairly simply, okay? You can be playing it every month, doing 30-day flies in TBT. Now, if we come down here and look at currencies, this is interesting to me. If you look at the dollar is trying to break out here. but it's having a hard time getting over this resistance zone right here. If it rolls back over, and my charts seem to indicate it's going to roll back over, okay? If I were to put that bar on there, as you've seen on my E-mini charts, you can see the bar is down here suggesting the dollar's going to come down, take out the 2020 lows and come down even lower. Okay, you can see that huge overhead resistance right here. Now, the way to play that, and you can see the divergence here, which has given us this kick up. We did take out this prior pivot high here, but I want to see the dollar get over 93.98 before I do anything, and that's sitting right on the 50 EMA, by the way. If this starts to roll over, then we're going to come back down. The way to play it, though, is just play the euro, because euro represents about 57.6% of the dollar index. You can see here, I don't think the euro is going to get much lower than this, okay? You can see the 50 EMA rising up. You can see the MACD starting to cross above the zero line. So I think the euro is going to move back up and hit that 120 area again, okay? Now, keep in mind, if we have a hard Brexit, and there's a lot of animosity going on between the EU and Great Britain, you're going to see the euro come back down. Okay, so that is the risk in this particular trade. If we look at gold, gold just it's broken. It's trying to ride this upslope and trend line, but it's broken. Okay, here it goes right here. You can see this, just followed it beautifully. We came down here, we tested it, and we're just riding this line right here. Okay. For me, I said unless gold gets back up over 1991 heading to 2000, I'm not going to trade it. I'm going to sit here on the sidelines. I do think the near-term movement of gold is more likely to be higher than lower, and I think over 90 days you're going to see gold possibly higher rather than lower. Here's the 50 EMA. You can see the trajectory on it. It's got an upward vector along with the 200 EMA. This is a potential target for gold, but I don't have a time frame on it yet of around 2130. If we look at silver, I still encourage our members to go long silver versus gold when you're ready to go in. I've got a target for silver sitting around 3160 right here, but we're still running sideways right here. Okay, so there's not a trade in this just yet. Now, we have been playing copper. Copper's been doing good for us. We got in copper back over here in early April, and we've been in it since. And it's doubled. And obviously, you can see it took out the pre-pandemic highs. Okay, so copper's been a great trade for us, and we're continuing to ride it here. Now we expressed it. I have several members that played it in the copper futures market, and others that played it in Freeport McMoran, which is another great way to play it. So again, we got into Freeport McMoran in the 670 area, $6.70, and now it's at 1627. So it's just a home run trade, all right? And there are several of those that we took back in early April because I just saw a buying opportunity that you could not pass up, okay? For our members, I'll kind of review more of this for our Sunday weekly market watch, some other ones that we're playing. If we look at oil, oil, as I said, broke 40 for the first time, but we're going to find support in this area here. If I blow it up, you'll see it's going to find support at this level, pretty much where we found support back in June. All right, so it's going to kind of bounce around here. So if anything, you could go out a couple of months and do some bull put spreads on oil. Okay, I don't think it's going to get much lower than say $35, $34 a barrel. So coming down here around $30 a barrel, $27, $28 a barrel, and doing some bull put spreads, doing maybe $2 or $3 wide. Going out a couple of months, but don't hold them for a couple of months. Maybe shut them down in 3 or 4 weeks. You should have some premium in them, right? So I think that would be a nice trade there. Nat Gas, well, Nat Gas is doing, we got really extended here. I'm looking still for Nat Gas to kind of settle in and move higher. But if we don't get that move, then oh well, because the pattern suggested a pullback and then a move higher. And then that second pullback would be the big move. Sometimes you don't get that pullback, higher high, and then a bigger pullback. Sometimes it just pulls back straight. So if that's the case, that's okay. But right now, I'm still waiting for it to kind of settle in and then move back higher. I thought it would do it right here when we had this first green bar. Right in this level right here, we started to settle in for 3 days and we moved up, but then it just rolled over hard. okay, and it's following oil. But sometimes Nat Gas does not follow oil, but in this particular case it is. So I'm waiting for it to bottom out somewhere in this area here and then make another move higher. And then in that second rollover would be the one I'd want to play. Okay. All right, guys, that's pretty much what we're seeing this weekend, what I'm seeing this weekend. Members, we'll go through some of these in a little bit more detail, some stocks, and then maybe some things to start thinking about as we start approaching the silly season for the 2020 presidential elections here in the U.S. All right, everybody, have a great weekend down here in southern Florida. We got a tropical storm moving through, so it's raining all day. So I guess it's indoors activity for us down here. Have a great one, everybody. See you guys later. Ciao.